There's a certain irony in calling oil black gold when the markets treat it like it's on a roller coaster. Just this past week, we've seen West Texas Intermediate or WTI crude shift from settling at 63.15 per barrel earlier in May to dipping down to 60.66 by May 22nd. Why? Well, a combination of rising U.S. inventories and whispers of potential production increases from OPEC Plus kept the upward momentum firmly in check. Brent crude, the global benchmark, has been less volatile, holding around 65.95, though trading has struggled to stay above that, probably in the coming days. U.S. Energy Information Association, EIA, forecasts $66 might be a magic number for most of 2025. Dependability feels like a luxury in this business. It is. Gasoline prices are a bit of a mixed bag too. The national average sits at $3.19 a gallon, slightly higher than earlier this month because, yes, the summer driving season is creeping in. But compared to this time last year, well, we're down 40 cents. On the future side, well, gasoline is currently trading at $2.17 a gallon. Lower prices than we've grown used to, yet at their typical season climb. Meanwhile, natural gas hit 342 per million British thermal units. With production, their exports at near record highs. It's high stakes all around, with prices surging as much as 10% earlier this week before cooling off slightly. The market isn't exactly subtle about its swings. On the production side, U.S. crude oil output remains impressive, nudging just under 13.39 million barrels a day. That's a 2.2 increase from last year despite a significant slowdown in new drilling. Even with rising efficiencies, the growth rate is tapering. Yeah, there's talk that U.S. production might plateau in a few years, potentially peaking around 14 million barrels a day by 2027. Natural gas production it's in record territory too, hovering near 105 billion cubic feet a day and showing no sign of slowing down. Even still, the strongest streams eventually run into headwinds. Imports and exports are seeing their own set of shifts. The U.S. crude oil imports have slid by about 16% from last year and currently fluctuate between 5.8 and 6 million barrels a day. Meanwhile, crude oil exports just reached 3.51 million barrels a day, surprisingly down 15% year on year, despite from week to week volatility. The clear exception is natural gas exports, particularly liquefied natural gas or LNG. The U.S. is supplying global markets at a staggering rate of 15 BCF per day. That's a 20% jump from 2024 and a critical factor in energy security for Europe and Asia. Canada predictably remains our dominant supplier, responsible for nearly 2/3 of U.S. crude oil imports. Mexico, Saudi Arabia, Brazil, and Venezuela round out the list of key nations that we rely on. Interestingly, global geopolitics have caused a steady decline in imports from OPEC and Persian Gulf countries. Canada's dominance isn't fading anytime soon, accounting for over 4 million barrels a day of all U.S. crude imports. Looking at upstream activity, rig counts tell a tale of calculated caution. The number of active rigs in the U.S. is at lows not seen since earlier this year. This isn't industry pessimism, but rather a disciplined shift. Improving operations mean we can maintain production at high levels, even with fewer rigs in action. Diamondback Energy, as I've stated before, notably signaled that U.S. onshore production may have already peaked, shifting the focus to efficiency rather than aggressive growth. Is that setting expectations or what? When it comes to mergers and acquisitions, the U.S. led with an impressive $17 billion in upstream deals during the first quarter of 2025. Standout transaction includes Diamondback Energy's $8.5 billion acquisition of Double Eagle 4. But the once frantic pace of consolidation is slowing, and with high asset prices and expectations and limited premium shale inventory bottlenecking new deals. Even global activity is tinged and with tempered expectations as we see the still rumored but unconfirmed mega merger numbers between Shell and BP tossed around. Where does all this leave us? Well, the U.S. oil and gas landscape is resilient, but we're moving toward moderated growth and deliberate decision-making. It's clear that we're entering an era defined not just by production records, but by readiness to adapt. Whether it's fluctuating global demands, the balance of inventories, or shifts towards smarter energy policy, the industry is evolving. Things are always changing, it seems. Efficiency and focus are the new tools sharpening our edge. I'm Mark Roach, and this is FutureWise Energy. Thanks for joining me today.